Everyone, please welcome FSOC Chair, Treasury Secretary Janet Yellen.
Good afternoon. I'd like to call this meeting of the Council to order. Almost exactly 1 year ago, the pandemic's outbreak caused significant stress in the economy and in the financial system. In response to the deep uncertainty, investors sought safety in the form of cash and short-term government securities. Bond markets became illiquid. If not for the swift actions of the Federal Reserve, Treasury, Congress, and others, those stresses could have led to an even greater economic contraction. Indeed, we're digging out of a deep hole now, but we should be mindful that the hole could easily have been even deeper. Increased capital and liquidity requirements imposed after the 2008 financial crisis helped banks weather the pandemic-induced crisis. But the fact that extreme policy interventions were still required to support market functioning should serve as a clear reminder. We have to do more to address vulnerabilities in the financial system. This year, I see three particularly important ways for the Council to begin doing that. The first is looking at vulnerabilities in non-bank financial intermediation. Last March, we saw evidence of how these vulnerabilities in non-bank financial intermediation can take the existing stress in the financial system and amplify it. It's encouraging that regulators are considering substantive reform options for money market mutual funds, and I support the SEC's effort to strengthen short-term funding markets. We also know that open-end mutual funds offer investments with greater liquidity than their underlying assets. While these investment funds play a critical role in financing the economy, I believe this particular practice should also be reviewed. In fact, the SEC has been studying the performance of open-end mutual funds during the March 2020 market turmoil, and this afternoon the staff briefed us on their initial analysis. As a next step, I've asked for an interagency assessment to determine if additional measures should be taken to address this financial stability vulnerability, and if so, to develop recommendations for the Council. The Council was also briefed by the Office of Financial Research regarding the performance of hedge funds through the COVID-19 crisis this afternoon. The pandemic showed that leverage of some hedge funds can amplify stresses too. This Council used to have a hedge fund working group, and as of today, we have one again. We're reestablishing the working group so that we can better share data, identify risks, and work to strengthen our financial system. The second area where we need to address vulnerabilities is the U.S. Treasury securities market. A deep and liquid Treasury market is essential for a strong U.S. economy. It's critical to the entire financial system. It supports the US dollar as the world's reserve currency and is the benchmark for asset classes globally, which is why last year's disruption of the Treasury market warrants a broad interagency effort. We have to better understand the factors that contributed to an increase in the demand for liquidity by all types of investors and a reduction in the supply of liquidity by dealers and principal trading firms. We also must strengthen the Treasury market itself and make it more resilient to future disruptions. Third, we can not only look back and learn the lessons of last year, we must also look ahead at emerging risks. And climate change is obviously the big one. It's an existential threat to our environment, and it poses a tremendous risk to our country's financial stability. We know that storms will hit us with more frequency and more intensity. We know warming temperatures might disrupt food and water supplies, leading to unrest around the world. Our financial system must be prepared for the market and credit risks of these climate-related events. But it must also be prepared for the best possible case scenario, that we begin a rapid transition to a net zero carbon economy, which also creates potential challenges for financial institutions and markets. On all these fronts, the Council has an important role to play, helping to coordinate regulators' collective efforts to improve the measurement and management of climate-related risks in the financial system. The three areas that I highlighted, vulnerabilities in non-bank financial intermediation, the resiliency of the Treasury market, and climate change, are major challenges that will require our collective efforts. But these are not the only challenges to financial stability we face today. We must continue to identify and address other vulnerabilities, such as cybersecurity risks, the growth of non-financial corporate credit, the importance of large banks and central counterparties in our financial system, the evolving role of digital assets, and many others. I look forward to engaging on all these issues with the Council going forward. Let me close on a personal note. This is my first meeting as chair, but as you all know, it is not the first meeting I've attended of this Council. I was a member for 4 years, and I have always viewed being a part of this body as some of the most important work I've ever done. Our task is to guard the nation's financial system, and it is an honor to be back doing that work and to be doing it with each of you. Next, we'll turn to our agenda for this meeting, a presentation from Federal Reserve Board staff on their recent work considering climate change within a financial stability framework. Afterwards, we'll have a brief discussion about actions other agencies are taking to address climate risk and their plans moving forward. I'd like to now turn it over to Elizabeth Kaiser from the Federal Reserve Board for the presentation, and Andreas Linnert is also available for questions.
Thank you, Madam Secretary. I'll briefly describe the Federal Reserve's framework for analyzing the financial stability implications of climate change, and then I'll be happy to answer questions from you and your colleagues. The Federal Reserve is considering the effects of climate change in the context of our mandates of full employment, price stability, financial stability, and the supervision of financial institutions. Financial stability refers to the ability of the financial system to absorb rather than amplify negative shocks. When the financial system amplifies a negative shock, both employment and inflation can fall far below optimal levels. For this reason, the Federal Reserve analyzes and monitors the resilience of the financial system to a wide range of potential shocks. The risks associated with climate change have the potential to be an important factor in the financial system's resilience. And for that reason, we've begun to analyze its potential effects on financial institutions and markets. We're still at the early stages of our analysis of the impact of risks arising from climate change on financial institutions, markets, and the system's overall resilience. However, we have an initial framework for fitting these risks into our ongoing monitoring of financial stability. I'll discuss that today. It was also published in the November 2020 edition of the Fed's Financial Stability Report. Climate change refers to the trend toward higher average global temperatures and accompanying environmental shifts, such as rising sea levels and more severe weather events. Economic and financial risks from climate change can arise from the acute and chronic hazards from a hotter planet, such as severe weather events, from the potential effects of measures to mitigate these effects, including government policies and technological developments, as well as from shifts in the perceptions of investors and consumers. These risks may be amplified by the financial system because risks may be mispriced and institutions may have leveraged exposures to the risks. Climate risks add a new layer of economic and financial uncertainty to a broad range of financial institutions and markets. Different sectors of the economy, geographic regions, and the markets for assets linked to those sectors and regions face new risks that may diverge from historical patterns. Indeed, these risks may already be manifest in some sectors and regions. As markets come to understand both the risks and the exposures of a range of assets, their market prices could shift abruptly. An example of how climate change could increase financial stability risks is through real estate exposures. Some residential and commercial properties will be exposed to damage from increased and more severe hurricanes, wildfires, or rising sea levels. Losses will be borne by the owners of these properties and by institutions holding assets linked to them, such as mortgage-backed securities. Given the uncertain timing and severity of future climate-related losses and the associated opacity of asset exposures, investors in real estate-linked assets may react abruptly to new information about a region's exposure to climate-related financial risks. The resulting price changes could be amplified by financial and non-financial leverage, funding risks, and the interconnections among affected market participants. Greater transparency through improved measurement and disclosure could improve the pricing of climate risks, thereby reducing the likelihood of abrupt changes in the prices of climate-related assets. Looking ahead to future work, it's important that we understand how resilient financial institutions and markets are to climate-related risks. Continued research into the interconnections between the climate, the economy, and the financial sector could strengthen knowledge of transmission, clarify linkages and exposures, and facilitate more efficient pricing of risk. The Federal Reserve is therefore undertaking research and analysis related to climate risks in a number of areas. For example, Fed staff have written papers about the effects of extreme weather events on retail expenditures and on changes in housing values from potential sea level rise. We're also learning from our colleagues at other US regulatory agencies, international authorities, academic institutions, and from market participants. However, I should emphasize that this work is at an early stage. To identify and assess the risks of the safety and soundness of supervised firms from climate change and to promote their resilience to those risks, the Federal Reserve recently created a Supervision Climate Committee. As a complement to this work, in order to understand the implications of climate risks for the broader financial system, the Federal Reserve also recently created an additional staff group, the Financial Stability Climate Committee. Thank you. That concludes my prepared remarks. I'm happy to answer questions.
Thank you so much, Beth. Are there questions for Beth? Well, let me ask you one question, Beth. I'm wondering if you can give us some examples of the kinds of data and methodology challenges that you face when you're doing this work to assess climate change as a financial stability risk.
Of course, thank you. So on data and methodology, as you can imagine, there are a number of challenges. One key challenge we face is really to translate, if you will, climate-related risks into economic risks, financial risks, and risks of financial stability, and to understand the linkages of those across the financial system. There's, of course, a lot of uncertainty that we are facing over the time horizon and the likelihoods of the various possible physical outcomes, and also uncertainty about policies that could be undertaken to mitigate or adapt to the effects of those changes. The geographic and sectoral differences in climate-related risks are also substantial. Climate-related risks or policies may really differ across geographic areas, sectors, asset classes, institution types, and so on. And so the availability of data along these dimensions is limited in many respects, especially when it comes to connecting those pieces together. The modeling, as you can imagine, is also complex. There could be different exposures to participants in different parts of the financial system, as well as linkages through financial instruments or contracts that could transmit risks. So a lot we don't yet know. Early days for sure. Thank you.
Beth, other questions for Beth? Okay, seeing none, let me say that the potential risks that climate change poses to financial stability will certainly be a focus for FSOC going forward. I'd also mention that within Treasury, I'm establishing a climate hub to focus on the opportunities of climate finance to support the economy's transition to net zero. And that will complement FSOC's work on climate-related risks. I understand that a number of other council member agencies have also taken steps to identify and address climate-related risks. And I welcome comments from other council members on what your agencies are doing to evaluate risks from climate change. Before I turn to several of you who've indicated a desire to comment here, let me ask Chair Powell, do you have anything that you wanted to add?
Thank you, Madam Secretary. Maybe I'll just briefly amplify what Beth said so ably. So climate change is an important issue. Of course, our broad response as a society to the challenges presented by climate change lies with our elected representatives. While decisions on climate policy are not the province of the Fed, climate change does come into our work to the extent that it has material implications for the pursuit of our existing responsibilities, particularly for supervision and regulation of financial institutions and for financial stability. As Beth mentioned, we're currently in the early stages of assessing these potential links. We recently established a supervision climate committee, which brings together senior staff together from across the Fed system to assess and ensure the resilience of supervised firms. We're also investing in research and analysis of the means by which climate change may affect the banking sector over time. This committee will also work with large institutions to better understand how they assess climate risks and incorporate them into their risk management frameworks. As with all of our supervisory work, we will tailor our approach and devote resources to those firms that face the most risk. This engagement is in its early days, and we're committed to a robust and open dialogue as work evolves. We also have work underway to integrate climate change into our financial stability framework. A changing climate may have many effects, which may be amplified by the financial system. Our new financial stability coordinating committee is dedicated to researching the potential vulnerabilities of financial markets and institutions, both from the consequences of climate change and the policies designed to mitigate its effects. One of our goals is to make climate change a part of our regular financial stability framework. An added benefit to this adjustment is the ability to update the public on this essential work. Climate change may affect many of the institutions and markets overseen by FSOC members. Updating analysis and risk assessment is critical to maintaining a safe and sound financial system. And I look forward to continuing to work with all of you on this important topic. Thank you.
Thank you so much. Let me now invite Chairman Harper to make some comments.
Thank you, Secretary Yellen, for including a discussion of climate change and its impact on financial stability in today's agenda. And thank you, Beth, for your observations as well. I might add that Beth and I are neighbors in the neighborhood together. The data about extreme weather events and climate risk are clear. Climate change is accelerating, and the number and costs of climate-related natural disasters is rising, often hitting disadvantaged communities the hardest. According to the National Oceanic and Atmospheric Administration, we had a record number of 22 separate billion-dollar weather and climate disasters across the United States in 2020. These hurricanes, severe storms, drought, and wildfires cost a combined $95 billion in damages. And the markets are already responding to this change, with financial services companies adjusting their business plans and committed to achieving net zero carbon emissions in their activities. In my view, the Council should focus on the financial risks related to climate change, and each of us needs to manage that risk within our regulatory and supervisory frameworks. For the NCUA, by measuring, monitoring, and mitigating such risks, we can fulfill our core obligations of maintaining safety and soundness of credit unions, protecting consumers, and safeguarding the Share Insurance Fund. In acting, I want to ensure that our regulated institutions remain resilient against all material risks, including the financial risks posed by climate change. By managing this risk, we will support U.S. economic growth. Additionally, we must consider not only the macroeconomic impact of climate change, but also the microeconomic context. Most credit unions focus on mortgage, auto, and small business lending. Over time, climate change will affect the value of collateral like homes and commercial properties, especially in areas affected by extreme weather, and vehicles as we transition to electric and hybrids. And a credit union's field of membership is often tied to a business like an oil refinery or a community linked to farming. The movement to renewable energy and changes in weather patterns will affect their operations and their members. To remain resilient, such credit unions will need to consider adjusting their membership fields or altering their lending portfolios. In sum, the council should quantify and determine the impact of climate change on the financial system so that we can each take actions to lessen the risk for the institutions we oversee. I look forward to coordinating with my fellow council members. Thank you.
Thank you. Director Calabria.
Thank you, Madam Chair. First, let me welcome all of the new council members. And as both the Fed, I appreciate Elizabeth recognized this, the Chairman Harper just recognized the importance of homes and real estate. Certainly that's what we do at FHFA, mortgage finance. I might argue that there may be no sector of our financial system more exposed to potential of the climate change than mortgage finance, given its tight connection to the housing market. We at FHFA are actively working to ensure that we are doing our best to account for these risks in our prudential supervision of Fannie Mae, Freddie Mac, and the Federal Home Loan Banks. For instance, we've already developed a strong framework for our regulated entities to respond to the impact of natural disasters as they may cause harm to borrowers and renters. For instance, the forbearance framework that we used in response to COVID was built upon the agency's longstanding response to natural disasters. We are, of course, focused on strengthening our capabilities to identify and assess the current and future exposure of our regulated entities to climate and natural disaster risk. And we are exploring ways to potentially enhance our supervisor and regulatory framework. For instance, last fall, our newly created Division of Research and Statistics brought together leading climate risk experts and researchers at our biannual Economic Research Summit. We're also excited to be announcing the hiring of 2 environmental economists here at FHFA that will start shortly. In November, FHFA finalized a regulatory capital framework for Fannie Mae and Freddie Mac that recognizes that the risks from climate change could pose are difficult to quantify, but potentially material to Fannie and Freddie. Loss absorbing capital, particularly in the form of common equity, is, in my opinion, the strongest protection for financial institutions against any negative shock, including those from natural disaster or abrupt repricing from such. Our first priority is thus building capital at the entities that we regulate. To help coordinate our many efforts on climate and natural disaster risk, last year we established an agency-wide working group made up of representatives from every major office and division. And this year, FHFA released a request for input on climate and natural disaster risk management at our regulated entities. This RFI requests information on a range of topics, including the disproportionate impact on low-income and minority communities, closing important data gaps, and enhancing our supervision and regulation. Since this is a public session, before I close, I want to strongly encourage anyone with relevant information and interest, including the agencies represented here today, to submit a written comment to our RFI, which closes on April 19th. Madam Chair, fellow members of the council, thank you, and I look forward to continuing this important work with you in other future matters. Thank you.
Thank you so much. Acting Controller Paulson.
Thank you, Madam Secretary, and thank you for your leadership of this body as we meet for the first time since you're becoming chair. As indicated in today's presentation by the Federal Reserve Board, financial stability implications of climate change is one of a number of areas that by its nature benefits from collaboration with multiple stakeholders, including market participants, FSOC member agencies, and international standard-setting bodies. Several agencies are charged with the responsibility of addressing climate change. The OCC's attention, however, as a prudential supervisor of the federal banking system, is always focused on the safety, soundness, and fairness of national banks, federal savings associations, federal branches and agencies of foreign banks. Our role is to ensure that those financial institutions understand the risks they face and have robust risk management to control and monitor the risks and their impacts. Those risks can arise in many ways, including contexts relate to climate change, either because of physical conditions or climate-related transitions in business and other environments. Accordingly, in common with many others, we are developing our knowledge of the risks in this area by engaging with relevant stakeholders. Within the OCC, the agency's National Risk Committee oversees our internal work on the subject as it monitors systemic and supervision risks facing the federal banking system. The agency is active domestically and internationally on issues related to climate change. For example, we participate in the Basel Committee on Banking Supervision's Task Force on Climate-Related Financial Risks. To date, the group's taken stock of member initiatives on climate-related financial risks, cataloging them for member organizations to benefit from one another's experience. Collaboration, domestic and international, is also critical to avoid risks of regulatory fragmentation and maximize the resources and effect of our efforts. Internationally active national banks and federal savings associations are already reviewing requirements applicable to their activities overseas. We look forward to continuing the work with FSOC member agencies and FSOC staff in this area. Thank you, Madam Secretary.
Thank you so much. Acting Chair Lee.
Thank you. Good afternoon, and thank you, Madam Secretary. The SEC very much supports FSOC's prioritization of climate change and its potential impacts on financial stability. We've taken a number of recent steps to promote consistent, comparable, and reliable disclosure on climate risks and opportunities to ensure efficient pricing and allocation of capital. So I will just highlight a few of those efforts. As an initial step, we recently announced that the staff will enhance its focus on current climate-related disclosures under the SEC's 2010 climate guidance to public companies. The staff will also be reviewing the 2010 guidance to consider how it can be modernized to accommodate the shifting landscape on climate disclosure. And I also recently solicited public comment on climate disclosure, which will help inform a potential update to our disclosure framework for public companies as it relates to climate change, should the Commission decide to do so. Now, in addition, the Commission has enhanced its examination and enforcement efforts regarding compliance with existing regulatory requirements as they apply to climate disclosure and also the implementation of ESG investment strategies. The Commission is also considering issues around shareholder proposals and fund voting as they relate to climate risks and opportunities and ESG topics. So that's just to highlight some of our main areas here. We very much look forward to engaging with council members on these and other critical issues. So thank you.
Thank you so much. Acting Chairman Benham.
Thank you, Secretary Yellen, and thank you for bringing up this issue and convening the meeting. But most importantly, I want to thank you for bringing up climate change as an important issue that the council will discuss. And of course, given what has just been said, I want to thank my fellow regulators for the work that they're doing, notably Beth from the Federal Reserve and of course, Acting Chair Lee at the SEC. Within the CFTC, there's been a significant amount of work conducted over the past several years on climate-related financial market risk. Notably, the Market Risk Advisory Committee, which I directly oversee, published a globally well-received report in September of 2020 that I believe could inform this body's deliberations over the next couple of months and years. Notably, among the 53 policy recommendations, one of the first is that the FSOC incorporate climate risk into its mandate. So it's very good to see this, and I think there's a lot of good deliberations that will happen over the next couple of months and years. And more recently, I recently announced as acting chair the formation of the Climate Risk Unit within the CFTC that will focus on the role of derivatives in understanding pricing and addressing climate-related risk and transitioning to a low-carbon economy. Look forward to continuing this important work in concert with the council members. And again, thank you, Secretary Yellen, for bringing up this issue.
Thank you so much. Chairman McWilliams.
Madam Secretary, thank you. It is a pleasure to see you at the council, and I would like to extend a warm welcome to new members. I also appreciate the opportunity to comment on this important issue. While the issue of the potential impact of climate on the financial sector seems to be gaining momentum among domestic and international regulatory bodies, it is worth noting that the FDIC supervisors have long expected financial institutions to consider and appropriately address potential climate risks that could arise in their operating environment is a meaningful safety and soundness concern. This includes physical risks associated with extreme weather events, such as hurricanes, floods, storms, tornadoes, droughts, and fires. We also expect institutions to mitigate the risks associated with adverse climate or weather-related events that are common to specific locations or particular areas of the country. Such activities can include ensuring the institution and its borrowers have appropriate insurance coverage, adjusting borrowers' cash flow estimates based on reduced agricultural yields or adverse business conditions, and complying with applicable rules and regulations and building codes. FDIC economists and financial analysts conduct internal analysis of a range of factors that affect economic and banking conditions, including the potential implications of changing environmental conditions. Several FDIC regional risk committees include environmental factors in their regular analysis, such as drought in the western states. The FDIC will continue to monitor the impact of climate and other emerging risks on the financial industry. We will continue to engage with other regulatory bodies, domestic and international, on how best to address such risks, and we look forward to contributing to interagency work in this area. Thank you.
Thank you very much. Independent Member Wortman. You're on mute. You're back on mute. You're muted, Thomas. Good. Yes.
I am speaking. My icon indicates
We can hear you.
that it's on.
We can hear you now.
Okay, good. Okay, okay, good. Thank you, Madam Secretary. As you know, and you just indicated, I am an independent member of the, and unlike the rest of the members, I neither head an agency nor take regulatory action. As the independent member, I pay
You're breaking up on us. We can't really decipher. Maybe your connection is bad. I'm afraid that your connection is not good. Move on. I'm sorry. We can't. Your connection is too poor for us to understand what you're saying. I'm sorry. Let me ask Superintendent Chopa to give remarks.
Thank you, Secretary Yellen, for bringing the issue of climate change to the forefront of FSOC's agenda. Like the Federal Reserve and the other members of the FSOC, a key priority for state insurance regulators has and continues to be monitoring and addressing how climate risk can impact the insurance sector. As with other financial sectors, the insurance sector is not only exposed to potential risks on the asset side of the balance sheet through their investments, but also on the liability side through the risks insurance companies underwrite. For example, property and casualty insurers and reinsurers face risks associated with the increase in extreme weather events and changes to weather patterns resulting from climate change that could impact the extent of claim payouts. All insurers, life, health, and P&C, face potential investment volatility associated with the transition to a low carbon economy. To be sure, insurance can be a mitigant to the effects of climate change, but it is important to acknowledge that the sector's ability to do so could be offset by increasing claims that negatively affect the insurer's financial condition, which in turn will affect the availability and affordability of coverage to consumers. Insurance regulators are keenly aware of the challenges that climate change can pose to the sector. For our part, last year, state insurance regulators, through the NAIC, formed a task force to serve as a coordinating NAIC body for discussion and engagement on climate-related risk and resiliency issues. Our work is focused on 5 areas. First, we have a work stream focused on solvency, which is examining the potential solvency impact of insurers' exposures, including investments, to a climate-related risk. This work stream will consider enhancements to regulator solvency tools to analyze and address an insurance company's potential financial exposure to both the physical and transition impacts of climate change. Second, we have established a work stream on climate risk disclosure, which is considering modifications to our existing NAIC climate risk survey to promote uniformity in reporting requirements. For many years, through the California Department of Insurance, the NAIC has issued a climate risk disclosure survey, which collects information on more than 1,200 insurers, capturing more than 70% of the U.S. insurance market, and provides insurance regulators with insights into how insurers assess and manage climate risks. The climate risk disclosure workstream has been considering modifications to the NAIC survey to better align with the task force on climate-related financial disclosures. Third, we have established a workstream on pre-disaster mitigation, which is charged with participating in multi-agency stakeholder educational efforts on coverage gaps and pre-disaster mitigation related to climate risks, and to incentivize insurer recognition of enhanced building codes and underwriting and rating. Climate resiliency initiatives such as building code enhancements and infrastructure improvements are critical to foretell the impacts of climate change to the insurance companies and the policyholders they serve. We believe as state officials, we are uniquely positioned to be effectively promote such initiatives, as many of these projects need to be implemented at the state and local level. Fourth, we have established a work stream on innovation, which is considering innovative solutions to climate risk and resiliency directed at reducing, managing, and mitigating climate risk while closing insurance gaps and coverage for consumers. Finally, we have established a work stream on technology, which focuses on the increasing use of technology to better assess and evaluate climate risk exposures, such as predictive modeling tools, primarily catastrophic models used for wildfire, hurricane, flood, and earthquake perils, among other perils. While this work will not yield results overnight, we hope our work will enhance the strength of the sector and help ensure insurance consumers are protected from some of the effects of climate change. I, along with my fellow state regulators, look forward to working with other federal and state regulators as we collectively monitor the impact that climate change will have on the sectors we regulate and U.S. financial stability. I also strongly encourage financial regulators, the administrations, and Congress to focus on providing support to climate resiliency initiatives in state and local communities to help fortify those at particular risk of the effects of climate change to reduce risk to the financial sector, including insurers, and enhance U.S. financial stability. Once again, thank you, Secretary Yellen, for bringing attention to this important issue, and I look forward to working with FSOC on it.
Thank you so much. Director Seitz.
Thank you, Madam Secretary. The Federal Insurance Office supports the FSOC's focus on climate change issues, and we look forward to working with the Council and its members on this important topic that is receiving increasing levels of attention in the insurance sector. The Federal Insurance Office is working with our colleagues within Treasury and across the federal government on these issues, as well as with state insurance regulators. We are also engaging with our international colleagues on climate change risk, including at the International Association of Insurance Supervisors. Finally, last week, FIO joined the UN Sustainable Insurance Forum, which is a signal of our commitment in this area. Thank you, Madam Secretary.
Thank you. And Acting Director Wiggio.
Great, thank you, Madam Secretary, and my fellow regulators for prioritizing this crucial issue. I'd like to express my appreciation for this timely and thoughtful analysis. In my role as acting CFPB director, I am particularly focused on humanizing the potential negative effects on the financial lives of America's consumers. I'm particularly heartened to hear the sharp focus on real estate and therefore housing in the presentation. I've made housing insecurity a top priority of the Bureau. We are beginning to think through how climate risk might impact consumers, but we know a lot already. Climate change may lead to population migration. For example, over 13 million Americans may migrate due to flood risk alone. This could stress municipal infrastructure and destroy family wealth. We're also concerned that climate change will widen existing inequalities. Financially vulnerable consumers, such as low-income consumers, generally face higher risks of seeing their income decline from natural disasters, and as those grow more frequent, they are encountering greater risk. This will exacerbate racial and economic inequity and heighten risks to homeownership stability. For example, formerly redlined areas have $107 billion worth of homes facing flood risk, fully 25% more than non-historically redlined areas. Given these considerations, I am excited to work with members of this group on this important issue. Thank you.
Thank you. Would anyone else like to comment? Well, thank you.
Yes,
both.
Madam Secretary.
Yes.
Hopefully you can hear me now. I am Thomas Workman, the independent member.
Yes, please.
May I say just a few quick words?
Yes, of course.
Yes. Unlike the rest of the members, I neither head an agency nor take regulatory actions. As the independent member, I do not face the many challenges that each of you do to lead a large government agency and to manage the complex attendant duties that arise from your role. What I offer and what I can do is provide an independent set of eyes on priorities, such as climate change, that you might choose to put before me and my admittedly small staff, and for which you believe a fresh perspective may be useful, especially in the areas that involve insurance and annuities, areas in which I have a long personal history. And like you, Madam Secretary, and all the members of this council, I too want an America and a world that are healthy, just, verdant, kind, and prosperous. Madam Secretary, I look forward to serving under your leadership as chair of the council. If I can serve you and thereby contribute measurably to the work of this council, I will be most grateful. Thank you very much.
Thank you very much. Thanks to everyone for your comments and updates. And I want to say that I'm looking forward to working with all of you and your agencies to make our financial system more resilient to climate risks. I just want to end by reiterating how important this council is to addressing the financial stability threats we face. A strong, resilient financial system is key to fostering widespread economic prosperity. We have big challenges ahead of us, and I look forward to working with all of you. Before we adjourn, let me ask if anyone has other business to raise. Okay, seeing none, my thanks. Can I have a motion and a second to adjourn the meeting?
So moved.
And a second.
Thank you. The meeting is adjourned. Thanks, everybody.
Thank you very much.
Thank you.